Hello my fellow investors and welcome back to another stock analysis video. Today guys, let's actually take a look at the company Home Depot because they do have earnings on Tuesday before market open. And well guys, Home Depot is one of those companies that kind of, I guess, sets the frame for pretty much how people are spending when it comes to their houses. So this is going to be fairly interesting how these earnings report come out. But for now, let's do a stock analysis to see if at the current share price it is looking like a pretty good buy. So with that said, let's get started with this analysis. Now before we actually get started with any numbers guys, I actually want to go over the upcoming estimates for their earnings. We got here EPS normalized estimate of $4.12, EPS GAAP estimate of $4.11, revenue of almost $38 billion. You can see it's kind of 50-50. There are 14 revisions saying that it will be on all of these estimates. However, there are 11 that are saying that is not. So that's going to be fairly interesting indeed. Coming now into the calculator, we got the ticker symbol of HD, market cap of $322.4 billion with a PE of 19.35. So based off of the PE with a current share price of almost $315, this is looking like a pretty good buy. However guys, if you have noticed Home Depot within the past couple weeks before this recent rally, Home Depot was actually sub 300. So technically you are buying it at a little bit of a premium today, but nonetheless, by the looks of it, it's still looking like a pretty good buy. On the 1 year chart, they are down 14.33%. On the year to date, they're down almost 23%. 52-week ranges is $264.51. Remember that number, and $420.61. So for all we know guys, this may be a pretty bad buy, but then again, who knows? I mean, it did go up nearly $60 in just a couple of days, so hopefully you guys bought during that low. But nonetheless, they do pay out a dividend of $7.60 per share, which is actually a really big dividend, and this is actually a yield of 2.41%, a payout ratio of 45.18%, a 5-year CAGR of a whopping 16.95%, essentially 17%. Guys, that's insane. 12 years of consecutive growth of this dividend, and unfortunately their ex-dividend date did pass as of August 31st. However, they should announce it for November 31st rather soon, and they did pay out on the 15th of September, but if trend continues, they'll pay out again in December 15th, and of course they do pay their dividends quarterly. When this dividend is paid out, in accordance to their current shares outstanding, this is almost $7.8 billion being paid out in dividends every single year. Based off of their 5-year average free cash flow, after this is paid out guys, they're still left with, take a look at this, $4.7 billion, and as of their last year's free cash flow, it is $6.22 billion. These payout ratios are 55.57% for the last year's free cash flow and 62.51% for the 5-year average. So the 5-year average is a little bit high, but the last year's free cash flow, it is still in line within my 60% cutoff. All in all, is pretty much just telling me that with this annual dividends per share, they can still afford it based off of their last year's free cash flow. Not so much for the 5-year average, but it's still okay in my personal opinion. Taking a look at some of these fundamentals, we got the net income 5 years ago of $8.6 billion to 1 year ago of $16.4 billion. Guys, that is a whopping increase of 90%, and on top of that, they have not decreased this a single year. So I'm going to give this net income guys a 100%. Coming now into the free cash flow, 5 years ago of $10 billion to 1 year ago of $14 billion, increase of 38% with an average of $12.45 billion. Now this is looking very good. However, 2 years ago to 1 year ago, they did go down a little bit. I could think the reason why they did so good 2 years ago is because of COVID. People were at home, they were doing nothing, so they were probably renovating their houses. So I think that's the reason why. Perfectly understandable as to why they dropped to around $14 billion the following year, but nonetheless, I will give this like a 90%. It is not perfect, but it's still really solid. Coming now into the revenue, this is looking amazing guys. 5 years ago of $100.9 billion to 1 year ago of $151.2 billion, increase of almost 50%, and every single year consistently increasing. I'm gonna have to give this a 100%. Coming now into the total assets minus the total liabilities, this is an absolute mess. There are certain years here that they are in the negatives, a couple of years here that they're in the positive, and as of today they're barely in the positive, $237 million. Guys, this is not good at all. Like, this is just not consistent in the slightest, but you know, it's assets minus liabilities. They're barely there when it comes to their average assets minus the total average liabilities, but it's still not that good. If we take a look at the average assets, we get around $62.7 billion. Average liabilities is unfortunately higher at $63.34 billion. And doing this difference, we get $631 million. Guys, this is all over the place. I essentially just have to give this a 0%. Coming now into the cash flow minus the liabilities though, this is also trending really bad. Even though we just saw up here that the cash flow is consistently increasing fairly nicely, guys, they are just piling on debt after year, which is just really bad. As of 1 year ago, they're at negative $61.6 billion. And as you can see, there hasn't been a single year where they brought it up a little bit, which is really bad. Average cash flow minus the average total liabilities, we get negative $51 billion. I'm going to have to give this, guys, essentially another 0%. Coming now into the shares outstanding. This, on the other hand, is looking really solid. We got 5 years ago of 1.2 billion shares to today, guys, of 1 billion shares. That is a decrease of the 5 year of 11.6%. And from the previous year to the current year, that is a decrease of a little bit more than 1%. Guys, every single year they have decreased their shares. And on top of that, even during COVID, they didn't even issue. They just kept it the same as 3 years ago. So that's actually not too shabby. A decrease in shares is awesome. A flatness in shares is also awesome, as long as they're not diluting you. And also remember, the more that they buy back shares, the easier it is to pay out that dividend. That payout ratio looked a little bit high, right? The 5 year average payout ratio looked a little bit high, but the more shares that they buy back, that payout ratio will actually come down because there's less money for them to give up, because there is less shares for them to give out that dividend for. So it's a good thing overall that they are buying back shares. So I'm going to have to give this, guys, a 100% for the shares outstanding. And lastly, for the cash equivalents, they're currently holding about $1.3 billion with an average of $3.2 billion. Overall grade, guys, we gave the net income a 100%. Free cash flow, 90%. Revenue, 100%. Assets minus liabilities, guys, 0%. Cash flow minus liabilities, awful too, 0%. And the shares outstanding are 100%, which gives it an overall grade, guys, of 78%. The two biggest ones here that are just drilling this company into the ground is these assets and liabilities. Specifically the liabilities, they just are piling on debt year over year. And if this was just a little bit better, this would be an 80+ company easily, absolutely easily. But 78% still passes my requirement to buying this company. And now let's make some assumptions, low, median, high, using of course revenue growth, the projected share buyback, and the required rate of return. Guys, this is what's going to tell us if at the current share price of almost $315, is this a good buy today? Let me just remind everybody, these share prices that I'm about to tell you guys right here, these target share prices, this is not what the company is going to. This is telling you the intrinsic value of the company based on their fundamentals. It's math. There really isn't any magic going on here. It's just numbers. So please do not believe that whatever number we get here after putting these assumptions, that the stock price will go there or that it should go there. It's not. It's just telling you what you should pay for the company to get a 10% return based on future assumptions for what the company will do. Because remember, every investment is the present value of all future cash flow. That is fact, and that is the way that you need to take a look at things, because remember, these tickers have a company behind them, have a balance sheet. We just went over their fundamentals. They're more than just a ticker, guys. So now let's actually do this. Coming over here to the growth tab in Seeking Alpha, we can see that the revenue growth forward is almost 6.5%. Now, I need to be conservative when it comes to these values. So let's take into account worst case scenario. And let's say that people are probably not going to spend a lot of the money into like renovating their houses, which by the way, probably they're currently doing that. So we'll see that when their earnings come out. So let's say that the revenue growth in the next 4 years, it'll grow at 5, 6, and 7%. Now for the projected share buyback, we did see that they're buying back shares, guys, at like 11%. Will they continue to do this? Probably not, but they do have a tendency. So let's say for the low assumption 7, for the median let's say 8, and for the high one let's say 9% projected share buyback. We get some target share prices, guys, for $245.97 all the way up to $268.89. Adjusting for debt, this does come down a significant amount because guys, they have a ton of debt. I mean, let's just face it, they have a ton of debt. Now, for the low assumption, it is now $198, and for the high assumption, it is $220, with $209 right in the middle. Adding a margin of safety of 5, 10, and 15%. This puts me between the buying ranges of $168.63 for the lowest assumption, the 15% margin of safety, all the way up to $209.31 for the highest assumption, the lowest margin of safety of 5%. So very, very interesting, because with these numbers, well, you can see that we're essentially not there. However, take a look at this, guys. The target share price for the highest assumption, not adjusting for debt, it is $268. If you guys remember that 52-week range, we were at $264 just a couple days ago, at least at the lowest point. So if you bought then, if you believe my highest assumption, not adjusting for debt, you would essentially get a 10% return in the next upcoming years if this actually comes true. Obviously, this is not financial advice, guys. All of this is just projections. And again, remember, every investment is the present value of all future cash flow. Have these calculators. It is available for free. Make your own assumptions. That's why I have them available in the first place. I also have, guys, the weighted grades. If you do not agree with the grades I gave it, give it your own grades and see where you may lie. I also have the book value available for you guys, the reevaluation, and even a dividend tracking sheet for companies that pay out a dividend. In fact, I have here Home Depot. I do own this company, currently paying me $13.31 in quarterly dividends, so it's actually not too shabby for me. But please have these calculators, make your own assumption. All I'm asking for in return, guys, for essentially free calculators and for even free content on the daily, just help me grow my channel, guys. I have no sponsorships here. I will never take on any sponsorships unless it's like food related stuff. The best way that you guys can help me grow, the best way that you could just help me support the channel, I mean, I'm just by myself here. Like, subscribe, comment, tell your friends, right? Share. That's about it. This is really about it. So thank you so much for everybody who have subscribed. I really do appreciate it. So now let's actually take a look at this dividend, guys, because $7.60 is massive. However, it's looking like a little bit expensive right now. But putting in $5,725, this nets you an annual dividends of $138.16, quarterly dividends of $34.54, and a monthly dividend of $11.51. Let's actually put this value over here at 264, which was the lowest point on the 52-week range, and let's see how much we get now. Putting in the exact same amount, we get $164.82. So it does go up a little bit, but it's still, it's still not there for like the $200, at least for me. But regardless, I still think that Home Depot is a company that you buy it for more than just a dividend. It has great fundamentals overall, except for those liabilities. But I mean, guys, Home Depots and Lowe's are essentially a duopoly, so I do not foresee this company to go down anytime soon. People will always, even if not right now, people will always renovate their homes. So all in all, Home Depot, as I said, I own this company. I like this company. I am going to be very curious as to how these earnings actually come up, because yeah, it's going to be very interesting. And it's going to say a lot even about the housing prices as well. So be on the lookout for that earnings analysis when these earnings come out. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites, a link in the description below. So with that said, peace out, and I will see you all in the next video.